All right, welcome to the ARMA Roundtable. Today is the 25th of April, 2024. A special guest, good friend of mine, Scot Ruble from Stratagem Trade. Scott was on the floor of the exchange for a long time, lots of great experience, longtime educator and trader, and Stratagem's got some great courses and concepts. And it's really, if you don't know Scott and Stratagem, you should get to know him because he's a great guy and good stuff that he's teaching. But welcome, Scott. I'm glad you're here to teach us about the Razzle Dazzle.
Thanks so much for having me, Tom, and hello, everybody. Hope everyone's doing well. So, you want me to just get started?
Yeah, if you have
Okay.
a disclosure slide, that's great. Otherwise, I can put one up.
No, I've got one. It's not as good as yours, but it's funny. So sometimes that's more
Funny.
important.
Funny's great. Yeah, I like that.
So my attorney said, "Oh, okay." So anyhow, this is our disclosure. It just says we're giving out education, not advice, and that's it. I mean, basically, Tom, myself, Airmare, Stratagem. No one's giving advice. We're just giving education. Read all the disclaimers here and on our website. And if Tom's disclosure is better than mine, or his disclaimer is more encompassing than mine, then use his. And by participating in the session, everybody's under the understanding that they're signing off on this disclosure. But I want to thank Tom. He does a great job. He's one of the most dedicated educators in this industry and trying to make sure that students succeed and to shorten the learning curve. And that's the key, is shortening the learning curve, because money's replaceable, time's not. You want to learn all this stuff in a year or two. You want to go through medical school in a year or two, or you want to go through medical school in 10 years. And Tom's doing a fantastic job at shortening the curve. For those who don't know me, I was a floor trader for well over a decade. I was on all the major exchanges, on the Chicago Board of Trade, Chicago Mercantile Exchange, Chicago Board of Trade, but I spent most of my time on the Chicago Board Options Exchange after the crash in 87, because the Chicago Mercantile Exchange options pits just dried up. After the crash in 87, there was no business. I wanted to continue trading options, so I went over to the CBOE. And if right there is where I stood most of the time. And the gentleman, for those who don't know, I was the co-creator. I get the credit for being the creator, but I was the co-creator of the Broken Wing Butterfly. The gentleman, I don't know if you can see my cursor or not, but in the bottom right corner
Yeah, I see him.
is the guy who also, well, he sort of sparked the idea, and then I sort of perfected it. He was kind of doing them in a different way, and then we beefed it up working together up in the members lounge. And Tom Sosnoff was standing over here on the right. um I don't know, any Scott Sheridan was always back here or up here. I don't know any other names that you know, but
Um, Charles Cottle, I don't think he was
nah,
there.
he wasn't there. He was on the board of trade floor. He's in I think the bond option pit or something like that.
Did you know Casey Platt?
No, I mean, I know who he is, obviously, and but um, we never
Yeah,
interacted.
just throwing some names out.
Yeah. Some of the big guys in Market Wizards book are in here. But it's this is the pit as it looked when I was in there. This is actually photographed in, I don't know, like the mid 90s, early 90s, mid 90s. But that was my home for well over a decade. There's a slide on here on who we are and stuff. You can read it at your leisure. I'm not going to go into it. We'll go straight into the class. And what we're doing is a little bit of a mini preview of the mini class that we're holding in May 4th on Razzle Dazzle. It was a trade that I just started doing with my students. And for I'd pepper the trade maybe once a month, once every 2 months. And then all of a sudden, for some reason, it just took off. And I think it has to do with the combination of a couple things. First of all, we've been in a slow grinding market higher for the last year and a half. And this is ideal situation for it. And we were in one trade that everything went wrong and we still made money. We had a bullish trade on, the market went down and we still made money. And people said, you know what? I'm always wrong. I need a strategy where I can break even or make money when I'm wrong. And so they started asking for more. And then last week we had a risk reversal on with long deltas. Well, the market was falling and people were getting nervous about that. I said, well, let's protect it with the Razzle Dazzle. And it worked out beautifully. It took away all the risk, and people were like, okay, I got to learn this. And so we created a mini class because really to go into every single detail is well over 2 hours. It's going to be an 8 hour class, and I'm going to actually do an example too the following week after, so the class is on a Saturday, and then Monday or Tuesday, I'll do an example to solidify everything. But the class is going to be recorded, and you can see it's coming up on Saturday the 4th. And that's what we're going to be talking about. But most people wonder, what is the Razzle Dazzle? And first of all, I am not responsible for naming it. I named one strategy in my life, the broken wing butterfly. every other every other strategy we've come up with, I let my students pick the name. And why they picked this name, I just think they thought it was funny hearing me say it. It's not the most beefy of names, but it kind of describes what it does. So I think that's what it is. But let's get into the Razzle Dazzle and what it is. So it's not as complicated as it's going to appear. I'm going to go and take things slow and easy. There's a couple more moving parts than some of you guys are used to. So it may be a little bit confusing, but it's really not. If you understand time spreads, you understand the Razzle Dazzle. So what is the Razzle Dazzle? It's just simply a long vertical roll where the purchase of the further out in time vertical spread is closer to the money than the shorter term that you're selling. And the reason for that is for protection. And it'll make sense in a second. Okay. And it's designed this way so that the the vertical spread that you're long being closer at the money protects the one that you're short, and the one that you're short provides time decay or theta offset that lower the cost of your long. And for those who don't know what a vertical roll is, it's just basically a time spread. Okay? It's a time spread with vertical spreads instead of one option versus the other. For example, if we're trading the QQQ time spread and you want to get long the QQQ, say 430 time spread, you may go out and buy the 430 call far out in time and sell the 430 call shorter in time, and you have a time spread. We're doing the same thing, but with vertical spreads. That's what a vertical roll is, not the Razzle Dazzle. The Razzle Dazzle is just the vertical roll with the strikes adjusted. So let's say we have on this call spread and it's running out of time. Okay. It's the April 26th call spread, expires tomorrow. You don't like it, or you do like it. You just think today's sell off was a fluke because of meta. We may be up tomorrow, but there's not enough time for this to actually work out. So I want to give it a little bit more time. So you want to roll it out. So let's say you want to move it out to Monday's expiration instead of Friday's expiration. Here on the left-hand side, you see the option chain that says the April 26th, 51.25, 51.30 call spread is trading for 45 cents. 290 versus 245. You pay 290, sell 245. You want to sell this out because time is running out and you want to capture the last 45 cents. And then use that 45 cents to lower the cost of going out until Monday, which is April 29th on the right. So you see it's the same 51.25, 51.30 call spread. The prices are a little bit different because there's more time until expiration. And you see that spread is trading for 60 cents. So you can roll out into the April 29th expiration by selling your long out that you're currently in for 45 cents and buying your new long for 60 cents. The net debit will be 15 cents to get an extra day of trading, which is a lot of times worth it. Okay. How many times have you been in a vertical spread and just needed one more day and it would have worked out perfectly? 15 cents is nothing if you were going to be right. And the 15 cents you're paying for is actually, time. The problem of doing it this way is leg risk. As soon as you sell your April 26th expiration spread at 45 cents, you go in to buy your April 29th for 60 cents. But right when you're hitting the send button, the SPX takes off and starts running up. And now you got to pay 65, 70, 75 cents for it. And so typically a vertical roll will just be done as a package to avoid that leg risk. Okay, where at the bottom you see that image that just came up. The top half is the long vertical spread we're buying, and the bottom half is the April 26th that we're selling to close out. It's that simple. Okay. Now, what a razzle dazzle is, or how it differs from a vertical roll, is that the strike prices are adjusted. It's really a vertical roll where the strike prices are adjusted. And it can be done to initiate a trade, not to just roll a position from one expiration to the other. For example, here you see the April 2nd 52-55 call spread. First strike is the 52-55. The spread we're selling is the 52-70-75. So the spread that's being sold is further out of the money. Thus, the one we bought is helping to protect the short. And then what you have on when you have both pieces on is the market has to go through your longs before it goes through your shorts. And what people are finding out is that typically when we're putting these trades on, they appear to be somewhat delta neutral. But the spread we're selling has almost, even though, well, let's say on this particular example, we're selling the 52-70-75 call spread. At the time, it may have a 2 delta, a 3 delta. The spread we're buying, the 52-55, 52-60, may also only have a 3 delta. But it's so much closer to at the money, and because there's more time until expiration, the probabilities of getting to the 52-55 long spread may be 30%, while the odds of the market getting to our short spread is only 10%. There's a lot of cool stuff that takes some time to go into in terms of the mechanics and everything else. And that's why we're having a whole 1 day class. But if these weren't two different expirations, if it was the same expiration where we're buying the 52-55, 52-60 call spread for 235, the graph would look like this. And then if we sold the 52-70-75 call spread at 90 cents to bring in some money and lower the cost of our long, that spread would look as follows. And then when you combine the two, you end up with a condor, as you see in the blue line. So this is you can think of this, if it helps, as a condor, just with two different expirations. And because we did two contracts, not one, it has $290 of risk. Now that, for those people who are very familiar with stratagem, know we don't mind putting some money to risk, but we're always trying to take money off the table once we had the trade on. So even though $290 is not that much risk for a trade in the SPX, the range in which we make money here is pretty tight. the odds of us closing inside that blue condor are pretty small. So we're going to always try to take some money off the table. Now, when you have on a Razzle Dazzle, what are you looking for? What do you want to see happen? Here's a great example. Excuse me. Let's work from the premise that the market is going back to 5,100, or we at least think it's going to go to 5,100. We can't tell the future, but we start on Monday. Okay. At the close, we'll put on the trade. And the first thing we do is look for our longs, and we go out by the 50.85 or 80.85 call spread. Excuse me. And that costs us $1. And we decide to sell the 90.95 with 1 day to go to expiration, because the odds of us getting to 90 or higher to hurt our short spread is pretty small when the market's closing at 50.10. So all we need is the market to close below 50.90. That short spread goes out worthless. We keep the 50 cents, and that lowers the cost of our long spread from $1 to 50 cents. Now what? Time period 2. What happened the next day? The market ran up, and it ran up huge. But the short call still expires worthless. We keep that 50 cents. And then what do? We have 2 more days until expiration. So on the close, we'll sell another call spread. And now we may sell the 5,100, 5,105, 5,110, 15. We want to go as far out of the money as possible. And there's going to be a balance. We already took in 50 cents on the first call spread sale. We kind of only need another 50 cents, another call spread sale, where we've taken in a total of $1 that pays for our entire long call spread. So now we have another call spread on. And you see that the call spread we're short is only 1 day away from our longs. We can, if we run into trouble, we can always roll it into the same expiration as our longs. Now what happens? Well, as we saw yesterday, the market sold off, came back, and pretty much closed unchanged. So what do you do now? Well, the short call went out worthless. So we've taken in a total of $1, and we can sell another call spread far out of the money and taking in another 50 cents. Now we're long a condor for a 50-cent credit. And what happens today? The market's going to go up or it's going to go down. Well, today it went down. Do you care? Does it matter? Well, obviously, we prefer, if we're long a call condor, the market to go up. But if you had this call condor on for a 50-cent credit, 50-cent credit, and the market sells off, you're kind of a little upset that the Meta took the market down, but you're kind of, a little part of you is giggling that, hey, I still made money even though I'm wrong. Okay. Now, why does it work? How does this Razzle Dazzle work? What's the magic behind it? Some of you guessed already that it's time decay. The magic is theta. And for everybody here, probably the first week they were learning options saw this graph. This is the graph of time decay. And we all learned, much to our surprise, that time decay is not linear. It's a function of the square root of time. So I put the expirations backwards, hoping that it makes sense. It makes it a little bit easier. Where we go out and buy the April. Well, let me get my annotation notes up here so I can draw. Here's our long, and every day that goes by, we get closer to expiration. Here was our first call spread sale at the end of the first day. It went out worthless. We sold another one, and then we sold a third one. So as time is moving towards April 2nd expiration, the sales of these call spreads to offset our cost of our longs is what's helping this trade. It's a beautiful thing. We're long a slow decaying option or spread, and we're short a fast decaying spread. The same principle behind a time spread. Okay, now let me see. Okay, so what if the market doesn't cooperate? Well, that happens. That happens a lot. But what I'm going to show you is for the next 10, 15 minutes is what happens if the market does not cooperate, but also all the functions of the Razzle Dazzle. Most of us have been using the Razzle Dazzle as sort of a time spread. We put the trade on and hope we can sell another spread every single day to where the amount of credits coming in are greater than the cost of the long vertical spread. But we've gotten so much interest about the Razzle Dazzle. People were like, can I combine this with another trade? Can I use this to hedge another trade? Can I? And we're going to show you in the next 15 minutes all the different functions that you can do, use the Razzle Dazzle for to implement a custom trade. For example, here was a bad example, and we still made money. Here's a Razzle Dazzle we did. March 27th, we started it. Look at where we bought the market. Look at the top line. March 27th, and the annotation of A. A is always the first trade. We go in order here. So we started with A. That was the first trade. And then we sold this as part of the package. So when you see two A's, that means we did it as a package. Okay. Now, I see some questions coming in. Hold on a second. Are you typically putting these 3 days out? Well, there's a whole bunch of criteria that it's a great question. It's exactly the question I would think an educated person who understands the strategy, at least in its fundamental form, would ask. But there's so many different answers. Some of it has to do with volatility, some has to do with the trend. If we're slowly trending up, we may go 5, 6, 7 days out, get a huge amount of credits going. The further out in time we go, the more risk there is, but the more credits we take in. We could also play with the expirations to 1 or 2 days, like I did with puts the other day, to hedge the downside. As the market was falling and falling and falling, people were saying, Scott, you got any low risk, low cost downside hedges? So we put on a Razzle Dazzle, and I'll show you that one too. So I can't really answer that without that a blanket answer of saying 3 days out. Here, this was, I think, 2 days out because of a weekend. I may be wrong. But I think this was 2 days out only because of the weekend. I think it was like a Friday and a Monday. Or no, it was 3 days. Because here's April 1st. Coincidentally, it was 3 days. So I see where you see the trend. Okay. Now, what you're going to see here, just because you're going to see a couple of these type of spreadsheets, I want you to familiar. This was done as a package. This was done as a package. This was done as a package because they have all the same annotations. Okay. Other trades you'll see single trades because instead of doing it as a package, we did it in the pieces. So it's important that I point this out for no other reason than you understand how we put the trade on so you have full disclosure. Okay. Whoops. Let me erase this. And I'm still getting used to it. It's been so long since I've done a Zoom. I don't know where it went.
What are you looking for?
To erase what I've written.
Oh,
I
I can
see. I
erase it
got
for
the
you.
yeah. Can you erase that? The second
There
bar
you go.
disappeared. Thank you.
There you go.
The
Yep,
second bar disappeared. It said erase, and so okay. Thanks, Tom.
sure.
Um, so essentially, what we were trying to accomplish here is this: it's a time spread with vertical spreads. We bought the long vertical for 235, and then we sold the short term further out of the money vertical at 90 cents. And then the next day we sold it again for 90 cents. And then the next day 90 cents. So what do we have? $2.70 credit on a long 235 vertical. Okay. But we never got off the third sale. Why? Here's how bad my timing was. Okay. I'm going to show you that just because I was a market maker and a huge volume market maker, okay, I was the second largest volume trader for at least a year. So you would think I'd know what I was doing in terms of timing the market. It means nothing. It means nothing. We essentially bought the dead top. We entered the trade over here on Wednesday at the close. The next day, the market went up. We hit the high for the year, 52.64. We rehedged by selling in our call at 90 cents. So what do we want to have happen? The market continue going up. Instead, we fell and we fell pretty hard. We went from 52.64 to 51.90. And why was I so bullish? Not because I have inside information, not because I know what I'm doing. Same reason you guys are doing. We were in a channel and we just fell to the low end of the channel. But who knows when that channel is going to end? If I was trying to time the market, I probably would have gotten out at 5,000, then at 5,100, and then 5,200. I would have been short. And at 52.60, I'd be like, this is getting painful. The best way to get from point A to point B is just, go with the flow, go with the current. Or as they say in the trading floor, the trend is your friend. This thing's trending higher. Why fight it? It means a lot of money's going to work. And so we were just going with the trend. And yet, on the way down, we were still able to close this trade out for a $65 profit, even though we bought the dead top. This one got people a little bit hooked. Now, what is fantastic about these trades is we can use them to roll, but we can also use them as standalone. And that's what we, like I said, we mostly been doing in our pod classes. It's how most people use them. They use them like a time spread. But I'm going to show you that we've also been using them as a hedge. And that's what really piqued people's interest. And they said, we got to learn this stuff. I'll take a day out of my life, a full day out of my life to learn this stuff because it'll save me a fortune over the long run. And so here's one that didn't pan out. Okay. I give you guys my winners and my losers. If you are in pot, you know that you see every single trade, not just the winners. And I do that with Tom as well. I don't think it's ethical just to show your winners. But here's a Razzle Dazzle we did on March 14th. And the vertical we won, it costed $1.80. But for the Razzle Dazzle, we got it down to 20 cents. So even though we were wrong, we were bullish. We were buying the market all the way down. Had we bought the call spread, we would have had $1.80 invested with the Razzle Dazzle. We got down to 20 cents of risk. And I could have taken that 20 cents off. I just got greedy. Okay, we could have probably taken it off for small credit, but I just got like, why sell it out at 20 cents when we still have time and we might be able to make a buck or two? And it didn't work out. But if you look at the components, and you can study this, it'll take a long time to go through this. I'm not going to waste your time, but you see every part of the trade, and you can get the slides if you want. You can ask Tom for it or write our office, and we'll be happy to send you the slides. But I show you every single component of every single trade. And here on March 15th, we entered a trade. There's the two pieces, what the graph looks like on the left and the right from one piece and the other. Then the adjustment, which was B, the second adjustment, which is C. And you can see in the bottom right-hand corner, the D quadrant. We had on a giant condor for 20 cents. At the beginning of the day, that thing was probably trading for $1.50. We had it on for 20 cents. So if you thought we were going to close in that range and paid $1.50, how much better off would you have been only losing 20 cents instead of $1.50? And that's on the losers. Okay. Here's it blown up. Okay. It's a pretty wide, big condor for 20 cents. Oh, VIX range. It really doesn't matter. The beautiful thing, someone just asked, what VIX range do you like for this trade? This is a beautiful thing about this trade. Is that when you're buying one spread and you're selling another spread, you're partially hedged with your deltas. You have theta, time decay, working in your favor, and your volatilities are offsetting each other to a certain degree. So it's really not even a volatility sensitive issue. It's more skew sensitive than volatility sensitive. But for me to show you that, we'll be off in a half an hour tangent. But the good news is you don't have to wait for the VIX to be on a 14 or a 28. Okay, so we've done them when the volatility was extremely low, and we've done them when the volatility was on the highs of the year. We're not even really looking for volatility ranges, okay? Because it's gonna, if volatility is a negative on our long, it's going to be a positive on our short, and vice versa. Okay. Now, the purpose of this is really the long vertical spread. You know, to answer you guys' question, it's going to have time decay work for me because I'm long a very slow decaying spread and I'm short a very quickly decaying spread, and I can sell another one and another one. We have a lot of delta protection because we're long a spread and short a spread. And we have a very good amount of volatility protection. Okay. Now here's some weirdness. And this was really where my students are in the pod class are trying to get me to take them. They're trying to cross-pollinate this with other trades as a hedge and to act as a hedge in itself. And I'm going to show you two examples. One where we're cross-pollinating with other strategies to augment their favorite strategy. Okay, whatever your favorite strategy is, BWB, whatever, you can use this to enhance it. And if you have a lot of directional trades or zero DTE trades, that you're worried about one direction more than the other. I know a lot of students are going in, or a lot of traders are going in and selling wide iron condors at the open and then buying them back at the close, or worrying about one side of the market more than the other. Last month, everybody was worried about the upside because we'd had these violent moves up. The last 2 weeks, I think people are a little bit more worried about the downside. And so maybe you would put on a Razzle Dazzle to protect a couple days of short iron condors for zero DTE trading. And that's what we're going to go into. And one of the topics we're going to be covering in the mini class. So let me show you an example of a combination where we combine the Razzle Dazzle with a condor. People said, I want to put condor because I think the market's going down. The problem is it's got a tight range. Can we use the Razzle Dazzle to augment it? Okay. That's going to be a couple steps. It looks more complicated than it is, but it's really half of these steps. We're just closing the trade down and taking profits off. So here you see we bought the back month. Okay, the April 12th. Then we sold 2 contracts of the April 10th, 2 days apart, not 3 days apart, to create a Razzle Dazzle. And then also we sold some April 12s that were in the same expiration as our longs to create a condor. And we took off with this strategy. The next box, D, you're going to see that as the market was moving around, we decided an expiration was approaching on the April 10th. Our short April 10th put spreads had gotten down to 30 cents. So we said, let's roll them out to April 12th to take in some money. So we took in 50 cents on 2 contracts. That's $100 coming in. And it's all about taking money off the table all the time. And then the last of these trades was just closing the trade down. Excuse me. As expiration approached, now you'll see in that closing bracket, everything's in April 12th now. And we just sold one condor at like 215, another condor at I think 240 or something. And what did we have on is still a condor afterwards that looked like this. After we took, look at the bottom here, we took in $620. We started with the trade that was initial small debit. And then we took $620 off the table. I call it harvesting. If we're going to do all this work planting seeds, we want to harvest some money. And it left us with this for expiration day. And this is the condor and Razzle Dazzle combined. $620 credit for this condor that goes from 49.60 to 51.15. Is that pretty wide, guys? It's $50 wide condor for $600 credit. Then people said, I got to learn everything about this. I'm like, guys, learn everything about these trades. Takes a solid day because you got to learn how the Greeks interact, volatility, or not volatility as much as skew, how wide to separate them, depending on what strategy you're combining them with. So there's a lot of things you can do with it. The thing is, this is sort of like, for anybody who's like works with tools and stuff, this is sort of like a hammer. There's a lot of uses for a hammer or a lot of uses for a screwdriver. There's some tools in your toolbox that you only pull out once every 10 years. This is a multi-functioning tool. This is one of those tools that you can pull out all the time. And because it has so many different capabilities, there's so many things you can do with a screwdriver or a hammer more than just put in screws. It requires a lot of information, a lot of education. So we also used it for hedging. Excuse me. Those who are familiar with me know that occasionally I do risk reversals. When volatility gets high, for the people who are like Robert, who are concerned about volatility, and then this sign of understanding of trading to be concerned about volatility. Volatility is the most important component as far as I'm concerned. Volatility is more powerful to an option price than delta for sure. Way more. So always knowing where the volatility is crucial. But we use Razzle Dazzles in our classes a lot going forward to help protect risk reversals. Now, what's a risk reversal? It's just simply selling a call spread and buying a put spread for a downside bet. Okay, most people, when they think the market's going down, are going to buy a put spread. The problem is when you buy a put spread, market usually stops going down and the cost of the put spread evaporates to nothing. By selling a call spread, you take in the money for the put spread. It's sort of like a collar. When you buy a put for your stock, you sell a call not because you want to limit your upside, but so that you're not paying a fortune to keep hedging. We do the same thing on the other way too with bullish risk reversals. If the market sells off, falls below, say, 5,000 in the SPX, and we think it's going to bounce again, we may do a risk reversal where we buy a call spread thinking we're going to bounce and then sell a put spread to pay for it. Okay. Now, the problem is everybody thinks you're going to need a first aid kit because if you're wrong, you get smashed on these things. Well, you really don't. And let me show you. The cool thing about the Razzle Dazzle is we did have on a risk reversal that was going against us. We got bullish deltas when the market was at about 50.50. We went down 100 points to 49.50 and people started getting nervous. I said, well, don't worry, we'll use the Razzle Dazzle to wiggle out of it. And when they saw us get out of all the risk, even though it was going against us, an elation came over them. It was a really cool way to wiggle. And I'll show you it. This was trade number 34 for the year and trade number 35 combined. 34 was the risk reversal, 35 was the Razzle Dazzle. Okay, now let's go over trade number 34 first, which is the trade that had us getting all beat up and bumped around. The risk reversal. We were long deltas in the market and the market was selling off. Here's the trade we entered. And you see that we bought the 51.70-75 call spread and sold the 49.50, 49.45 put spread to pay for it. We actually got it on for a 10-cent credit as a group. Now, when you're looking at the market right now at 50.34, you're like, oh, that's pretty far out of money. It really wasn't that far out of money, guys. Remember, we were at 50. We had bought the market at 52.60. If you like the market at 52.60, you gotta like it at 51.60 or 70. And so when the S&Ps fell 100 points, we said, let's get along some deltas. And when it got down to 50.50, we put this order on. And at the bottom right-hand corner, you can see the graph. Even though we were in a bullish trend, every bullish trend has a couple days of selling. So it doesn't necessarily mean the trend is over. And so what we did is we said, well, until the trend is over with, this pullback is an opportunity to get long. So let's get long some deltas. And we bought a risk reversal. And I only did it one time because students hadn't done a risk reversal in so long. So we do it small. And then what happened? We kept selling off and people got nervous. Look at that. Just in a couple days, we fell from 50.50 to 49.50, another 100 SPX points. And when we're at 49, 53, 56, the lows, we're right touching that short put spread, and people were starting to get nervous. Like another couple points lower, and it's in the money. Like, well, we can close it down, we can roll it out, or we can razzle dazzle it. And students said, show me how to razzle dazzle it. Okay, so there's the risk reversal. We got it on for a 10-cent credit. Then There's the long call spread for those who don't know what a risk reversal is. There's the short put spread. And we were at the left side of the graph. That was making people nervous. So enter the Razzle Dazzle. And without going into too much detail, we essentially bought the April 23 75.70 put spread for 60 cents. Sold the April 22 put spread, 1 day less time, at lower strikes. Again, the definition of Razzle Dazzle is our longs are closer at the money than our shorts. And you can see that this thing cost us 30 cents there, but we actually sold the 45.40 at 50 cents instead of 60 cents because the market was moving and I didn't want to miss the trade. So we were into this for a $400 debit. Now people are not happy about a $400 debit. Well, we'll harvest it, so don't worry about it. As time until expiration passes, this starts acting like a time spread. Meaning, if you're long a back month and short a front month, they're opening up, they're expanding, and a profit is occurring. And so we could roll from, look at the bottom, we could roll 9 contracts from the 49.50 45 strike to the 49.45 40, 1 day closer to our longs, meaning roll our shorts to the same day of our longs and leave a condor on. And taking 50 cents. Now, when we paid 40 cents to get the trade on, we take 50 cents to take the trade off. We're left with a 10-cent credit. We harvest it and we have a Razzle Dazzle hedge on for a credit. And we only did 9 contracts. Why? Because here's the beauty, guys. Here's the magic. If you're drifting off, this is really important slide. Notice how the top Razzle Dazzle was 10 contracts. The bottom rolling, we only rolled 9 times. Why? 1 contract absorbed the risk reversal that was going against us. Think about that. We're short 1 put spread, rolling 9 instead of 10 contracts left us with a put spread to hedge our risk reversal put spread. So over here, you see that on the bottom left side is the risk reversal. We're short 1 put spread, the 50-45 strike. And you see over on the right-hand side in the top right corner, we did 9 contracts because one of them closed out our short risk reversal put. And now we had to trade on for a $50 credit, and the risk reversal was a $10 credit. Another way of looking at it is this. Some people can't picture it, so I put it in the spreadsheet form, which should be easier to start. Over on the left where it says start, that's our original trade. April 23rd, we're long under the green, the 75.70. We're short a put spread at the 50-45, which is the red ink, which is the risk reversal. And we're short 10 contracts of the April 22 45-40 put spread as part of the Razzle Dazzle. Then we rolled 9 contracts. And you can see on the right how it matches up. And we're moving our April 22 on the right to the April 23 on the left. And how they net out is this. In the April 23, we now have a condor. In the April 22, we're short 1 put spread that we just bought back for 50 cents later, or 45 cents. It went out worthless, but just to close it out, I wasn't worried about it, but just to close it out so we could discuss it as a group, I closed it out. It was only 45 cents. But what it left us with is here's the Razzle Dazzle. Here's a condor on for a $50 credit. Or if you look at each piece individually, the final risk reversal, you see the risk on the left is gone. Remember how it had the risk over here where we had the short put spread going down like this? It's gone. So all we have is upside potential for a $10 credit. And then we have on the Razzle Dazzle that is now no longer Razzle Dazzle, but it's been converted into a condor for a $50 credit. And our risk vanished. The risk that I was getting emails every single day about, hey, Scott, you remember we have on this risk reversal. Scott, are you nervous about this risk reversal? Scott, we're getting close to our short put spread on this risk reversal. When are you going to roll it? Or did you forget about it? Do you have a plan? Could you share your plan with us so we don't have to sweat? What put spread? It's gone. Some David Copperfield stuff went on. No, the Razzle Dazzle. And this is what people are, oh, well, I'd say probably half of the people want to learn it because they are fans of the time spread and they want the benefit of doing time spreads with verticals and at different strikes. And the strike selection is key, and they want to learn about that. But I would say the other half that want to learn it as a hedge want to learn it for an emergency escape hatch, like you saw on the risk reversal here, or there's a lot of zero DTE guys out there that want to put one of these things on so that when they sell their iron condors every single morning, they only have to worry about the market moving in one direction, not both directions. And it doesn't cost anything. Or it may cost them 10 cents. But if the put spread they're selling is 70 cents and the call spread they're selling is 70 cents, what's it taking in $1.40? What's a 10-cent hedge? Now they're taking in $1.30, but they only have to worry about one direction. And so I'd say half of the students are wanting to learn as a standalone, and half of the students are wanting to learn as a hedge. Now, some of the questions that came in were really good questions about volatility and skew and things like that. You can't throw out a blanket statement on how many days to go out until expiration. There's several factors at play, especially when it comes to like, is this a standalone trade or is this a hedge? If this is a hedge, what's it hedging? How far out in time is that position you're trying to hedge? That's going to change the dynamics and parameters of the separation in how long you space the razzle dazzle apart. And that essentially is just the razzle dazzle, guys. Any questions? I know there's a lot there. There's a lot of moving parts. It's probably the most amount of moving parts I've ever shown you guys when doing an airmare roundtable. Some people probably totally get the concept, and half of the people are probably like, two different strikes, two different expirations, four strikes in total because they're spreads. And then I roll it, they create two more spreads or strikes. This is getting complicated. It's really not that complicated. It's
Did you
essentially
get
just,
to,
yeah,
did you see Eric's question about what delta do you sell?
again, that's one of those things. Are you referring to as a package or are you referring to as a hedge? Are you trying to hedge a package or a spread that could go against you, or are you trying to create a profit center?
I'm guessing he's asking what delta on your short strike would be.
Well, that's what I'm assuming, but
Yeah,
that's going to vary depending on what you're using the tool for, right?
right.
The hammer's got two sides. Okay, it's got that claw side and the flat side you nail, you know, disobedient kids with. So at least that's what my dad used a hammer for. I don't know what
The
you guys
the
use it
old
for.
the old days, yeah.
He had an attitude adjuster, he used to call it.
Right.
The beatings will continue until I start
Till
smiling again.
Oh, we used to say in the Air Force and Strategic Air Command, the beatings will continue until morale improves.
Yeah, yeah, or the firings
Same
will
idea.
continue. Yeah,
Yeah.
yeah. Or the pay cuts will continue until you're
Until you're happy.
until you're happy. Exactly. Again, Eric, there's not a blanket statement, and that's why this class takes up an entire day, and it's going to be a fast moving day. It's not slow and think and look at this graph, and there's going to be a different delta on your short depending on how aggressive you want to be, how much time until expiration. You could sell something that's 25 deltas on your short and get a good deal of money coming in. 25 delta is going to be a buck and a quarter on a $5 call spread by definition. Or you could go out to something that's like a 10 delta and get 50 cents and be almost assured that you're not going to have to sweat on it or roll it. It really depends on your longs, the cost of your longs, how many days. Are you trying to do this for a credit? Are you trying to do this as a hedge? All these different variables have to come up. And that's why I can't even do it in a pot class. I can't do it in a 2 or 3 hour pot class. We're going to go 8 hours with maybe two 5 minute potty breaks and a half-hour lunch. That's it. And it's going to go at a fast pace because the slides are crazy. And it's broken into standalone, hedging, and being grouped with a different trade to augment the different trade. Like you just saw 3 different uses for it. Now we have all the different possible separations of expirations. We have all the different strike prices. There's a lot of criteria to go over. Commission will be an issue. Okay. I always hear about people complain about commissions. I tell my students this: if you're worried about commissions, you're in the wrong business. If you got to worry about, you know, I mean, I pay a huge amount of commissions. At the end of the year, it's gagging how much I pay. I'm like, God, I paid somebody's salary or 2 people's salaries this year in commissions. But when you think about it, when we're selling a spread one time at $100 and you're paying $2 in commissions, or we're selling a spread at $3 and you're paying $2 in commissions, it's nothing. I guarantee you guys giving up way more money and not on, a lot of people, most people give up more money on not knowing how to price a spread or an option correctly and giving up too much bid ask than commissions. And there's a firm out there, I'm not going to mention names because we're in a litigious environment these days, but there's a firm out there that charges no commissions. Nobody wants to be there for a reason. If I
Makes
don't think
sense.
I can make more money on a trade than the cost of the commissions, why am I in that trade? Yeah, $10 evaporated by the commission. So we got a $10 credit and we had to pay that to the broker. So now we got on a free condor, $50 wide. I don't know if I want a $50 condor free that I can make $1,000 on because I don't want to pay that $10 commission. Or you can just buy a naked call, let it ride, and hope it works out. You're only paying one commission. And I'm not being a smartass here. I'm just saying every single trade or adjustment I do has to be intelligent enough where the commissions aren't a concern. Or why do the trade? If I can take off all my risk, okay, we start out with that 10 lot of risk reversals. Or I don't know, some of you guys looked at my Facebook and were asking about the dragonfly I did in Tesla yesterday. I did 5 contracts of a Dragonfly in Tesla. Okay. After the earnings came out, I put it on at the close right before earnings. At the open right after the earnings, I hedged it off, and I've got on this giant condor for a $280 credit. So a lot of people have been asking about that. And then I said the same thing to my students. Hey, I think Meta's going to go down. They're going to beat earnings. Fine. I don't care. They're still going to go down because everyone thinks they're going to beat earnings. Everybody wants to buy Meta. Nobody wants to own Tesla, so Tesla went up. But the point is, when I put on this Dragonfly, it was a $500 debit. After earnings came out, the market ran up, and I hedged it off, and I took off all the risk and left on a $280 credit for a super wide condor. Who wouldn't pay the commissions to take $780 of risk off the table? Would you rather have that $500 of risk floating around between now and May 17th or whenever the expiration was? Where if the stock falls the next day, like you often see after earnings, you lose not only your initial commissions, but the $500 investment. And that's not to say don't take commissions seriously, but I don't do a trade unless the commissions shouldn't even be a consideration.
All right, Scott, I think that's it for the questions.
Okay, great. Um, and I'm
So,
not trying to be little in time. I just want to make it clear. I'm not trying to be little people who are concerned about commissions, but
yeah,
to
that
me,
makes sense.
it's picking up pennies to save, risking dollars to pick, avoid giving away pennies. It's not worth it.
Right.
Um, now, we talked about this earlier, Tom, and well, we didn't, but you and Glenda did. Are you guys getting a discount? Your people always get a discount with us. The cost of the course is $399. The airmare discount goes down to $379. You just type in Arrow 5, it's a 5% discount.
Well, I put a link in there,
Oh,
airmirror.com/RD, and that takes you right to the page to check out
oh,
with the good price.
okay. Yeah, and with it, you get the full day of instruction with criteria. You're going to get a copy of all the slides, all the recordings. You guys can add today's slides too if you want to, just ask Tom for them or ask my office for them. And then that week, whenever it makes sense, probably Monday, but I might wait till Tuesday or Wednesday when I feel more comfortable that it's going to be a winning trade based on the criteria you're learning. We'll put on a bonus trade for an example. And hopefully, most of the time I've done this, we've made the price of the course back. Okay, and this is everything that's included. You can see it on our website. Other than that, Tom,
Hey, I like that
Major
airplane.
Tom,
My favorite.
that that's what you used to fly, baby.
It was such a fun plane to fly.
You know how hard it was for me to find that image?
I bet. I mean, they stopped making them in the early 60s. They're
They're
getting
actually starting to
replaced.
make them again.
Well, they're making that T7 Red Hawk
Right.
to replace it. But
Yeah.
yeah, that was sure a fun airplane. Roll rate of 720 degrees per second. It was great.
The vomit comet.
Yeah, pretty much.
I
All
don't.
right, well,
Okay, Tom. Thanks so much. And everybody, thanks for your kind attention. I appreciate it. There were a lot of great questions.
thanks, and I hope you have a great class and take advantage of that good price because I'm sure you'll learn something and pay for
And
it
it
pretty
goes up to
easily.
500 bucks afterwards. And we don't joke around with that.
There you go. So get it while you can. Buy low, and then you don't have to spend the extra money on commissions,
Well,
just
actually, you know what? I got some people, I would say half of our students who will buy this course will pay full price a month from now
Oh yeah.
because they're kicking
So
tires and they're like, you know what? I don't know. And then all of a sudden, they know
yeah,
somebody that's seen us do the trade and they heard about the trade and they're like, I know I should have taken the class and I got to pay for it full price now.
And
you
they
know.
will.
And I would say literally half of these mini classes we do, people end up paying full price later, and they say, "Well, I couldn't make it to the class." It doesn't matter; it's recorded. You know, you can listen to it
Right.
anytime, and then when you pay full price a month after the class, you're listening to the recording anyways.
Right.
So,
Well, I'm sure it'll be a good one. So take advantage of the good price and have a good class, Scott. And yeah, we'll talk soon. Thanks again. Really
okay,
appreciate it.
thanks so much, Tom, and thanks everybody.
All
Bye
right. Thanks.
bye.
Yep. Bye.